3 years. Okay, so and then if you look at those 3 years, you add together, so total is the same. Is that right? Total is the same. Okay, so total about these, that's why we said this is the differences here is only temporary differences. Okay, it's only a temporary differences. So now we understand this story now. So then let's do the journal. Let's work on year by year. Okay, let's say this is year 2021. Okay, for 2021, this is the current year 2021. Okay, pre-tax account income is 100, right? And then we know taxable income is 60, right? The difference is 40, right? Difference is 40. So the difference is 40. Remember the 40 here because we don't pay tax, right? What do we pay tax in the future, right? We pay tax in the 2022, we pay tax on that 20, right? Then 2023, you pay tax on 20, okay? So that's what total future taxable amount is 40, okay? So you add those together, right? Oh, this is just this, right? So that's the total, this is the total future taxable amount, okay? Future taxable amounts, right? So then, so this is what taxable income, right? 60. So now let's say it's 25% of the tax rate, 60 times 25%, you got 15, right? 15 should be what? Income tax payable. Okay, that's why you credit, right? This is the one of the liabilities. Okay, you owe government tax 15. How about the future taxable amount? 40 times 25, right? So you're gonna pay tax in the future, right? So you have liabilities 10, right? Let's say beginning balance of this account is 0. So how to make it become 10? You need to add credit, right? You credit 10 to defer tax liabilities. Okay, and then the last item here is called income tax expense, which is the balance, the total. Question at this moment?
Oh, so for year 2021, you deduct 40. Is it that one is a future tax payable?
40 is a future taxable amount.
Oh.
It's not a liability. 40 is not liability. 40 is what? In the future, we're going to pay tax on 40. The real liability is 10, right? Because you only pay 25% on the 40s, okay? So you're liable to pay 25% over on the 40s. That's why the 10 should be your liabilities. We call that deferred tax liability.
Okay. So, okay, 40 is a future tax amount. It's not liability.
Yeah, it's not liability. It's the future taxable amount. You're gonna pay tax on those amounts, but you pay tax only 25%, right? So that's why 25% times 40. So you got 10. So 10 is your liabilities. We call that deferred tax liability. That makes sense, everyone?
Okay.
So you have two liabilities. One is income tax payable, which is based on the taxable income, right? So you owe those tax, right now, right? So in a couple of months, right? Another one is that you owe the tax in the future, okay? Because you're going to pay tax on that in the future. Okay, two liabilities. These are all liabilities, right? Income tax payable and deferred tax liabilities. That makes sense, everyone? Any other question at this moment before we move to 2022? What? Yeah, if you have again, I mute you guys. If you have questions, just unmute yourself, okay, and then you can ask questions, okay. Then if you don't have question, then you can just unmute yourself after you ask a question, okay. So let's move on, okay. Let's talk about 2022, okay. For 2022, so pre-tax account income is 100, right? So now taxable income is 120, okay. And then we say 25% is a tax rate, right? So 25 times 120, that's how we got the 30. 30 should be the tax we owe right now, right? So we call that income tax payable. That's where we have the credit, right? Income tax payable. Then how about the future taxable amount? Remember it was 40, right? So now you decrease by 20. So now you have what? you have 20 only, right? Future taxable amounts. Okay, so then what is your liability? 20 times 25, right? So you got 5, right? So 5 should be the liability, okay, related to that future taxable amounts. So it was 10, right, at the beginning of the year, but now at the end of the year should be 5. How to make it become 5? We have to debit 5, right, to make it become 5. So that's why the journal here, you can see we debit 5 to this deferred tax liabilities. And then the last item is always the income tax expenses, which is the balance, right, in that journal. Okay, that's how we get the 25. This is 2022. Question on this part? 22. You good, right? Okay, 23. Year 2023, so now the pre-tax accounting income is 100, taxable income is 120, right? So then 120 times 25, you got 30. 30 should be income tax payable, right? So we credit, okay, this one. And then how about the future taxable amounts? We have 0, right? So there's no difference at all, right? So we have 0 future taxable amounts, okay? So now times 0 times 25 is still 0. So this account should have 0 balance, okay? So how to make it 0? So we should debit 5, right, to make it become 0. And then we should debit income tax expenses to the balance. Okay. Everyone's okay so far? Any question? So see the income tax expenses, okay? Always the balance, okay? So you can see, the good, this chapter is a little complicated, okay? But the good thing is we only have one journal, one type of journal. The journal just like this, okay? You just learn this, but with a little different version, okay? You're gonna change a little bit, okay? But just the same type of journal, okay? And then when you write this journal, income tax expense is always the balance, okay? And that's how we determine the income tax expenses. This is the correct way to determine the income tax expenses, okay, by writing these journals. Okay, if you don't have questions, again, this is what deferred tax liability. In this case, it was 10, right? Because future taxable amount was 40, right? So that was 10 initially, and then it decreased by 5, decreased another 5, then by the end it becomes 0. Okay, so that's the deferred tax liabilities. And then this is what? This is the second approach, called the balance sheet approach. Okay, so just try to show you the balance sheet approach, what we're gonna do, right? So again, this is just like a optional, okay? So if you look at the balance sheet approach, you see the accounting book value, right? So you look at the balance sheet, the item, right? Which is what? Which is this equipment, right? This equipment will be reported as an asset in the balance sheet. So it was cost is 60, right? Remember, depreciation expense is 20. That's why the accounting book value at the end of first year should be 40, right? But tax basis, guess what? It's 0, right? Because what? Because 60 minus 60, right? So you have 0, okay? 0 balance. The whole 60 will be deducted, okay? So that's why you have tax basis 0 balance. And temporary differences is 40. Okay, so 40. So 40 temporary differences, which is what? Which is the future, right? So you don't pay tax right now, but you're going to pay tax in the future. This is the future. This is called the future taxable amounts, right? So then this one times 25%, you got 10. 10 should be the deferred tax liabilities. Okay, so if you have a deferred tax liability, you should have a 10, right? So it was 0 at the beginning, so now it should make it, you should have a 10, right? So how to make it 10? You should credit 10, right? So to this accounts. That's exactly the same with the journals we talked about the first semester, 2020. So you can see here, right? So we credit 10, right, to this. Okay, so let's go back to this. So again, this is the